Most people don't realize this, but where you put your money in 2025 could be the difference between struggling financially for the next decade or setting yourself up for life-changing wealth. Right now, as you're watching this, you have a decision to make. Will you let your money sit idle, slowly being eaten away by inflation, or will you put it to work and make it grow faster than ever before? 2025 isn't just another year, it's a pivotal moment. The economy is shifting, new technologies are booming, interest rates are adjusting, and opportunities are emerging for those who are paying attention. In this video, I'm going to walk you through exactly where smart money is moving in 2025, not hype, not guesses, but real strategies based on what's happening right now. So if you're tired of feeling behind financially or wondering if you're making the right moves, stay with me, because by the end of this, you'll have a clear action plan that you can start today, even if you're not an investing expert. Let's get one thing straight first. Holding cash in 2025 is not a strategy. It's a slow bleed. While it's crucial to have an emergency fund, and we'll talk about that, anything beyond that needs to be working for you. Inflation, even if it slows down compared to 2020-2023 levels, will still quietly chip away at your money's value if it's just sitting in a traditional savings account, earning practically nothing. So, how do we outpace inflation, grow wealth, and still sleep at night? We diversify into smart assets that can weather different economic conditions. First, let's talk about stocks, riding the right sectors. The stock market will always have its ups and downs, but if you zoom out and look at decades of history, it's clear stocks are one of the most powerful tools for building wealth. In 2025, the key isn't just owning stocks, it's owning the right sectors. Artificial intelligence, green energy, cybersecurity, and biotech are where the serious growth potential is. AI is no longer hype. Companies like Nvidia, Microsoft, and smaller, lesser-known firms are pushing the boundaries daily. Think about it, who will supply the chips, software, security, and infrastructure for the AI-driven future? Those are the companies that will lead. Green energy is another tidal wave. Governments are mandating cleaner energy use. Solar, wind, battery storage, and EV technology are exploding. And in these spaces, especially those that control rare minerals needed for batteries, are set to grow enormously. Cybersecurity might sound boring, but in a world where cyber attacks can cripple hospitals, banks, and governments, investing in companies that protect data is a smart bet. Finally, biotech is booming thanks to AI, assisted drug development, and an aging population in need of innovative healthcare. Buying into these sectors through F is one of the safest ways to capture the upside without betting on a single company. FS like QQQ for tech, iChillin for clean energy, or Hack for cybersecurity allow you to spread risk while riding powerful economic trends. They offer instant diversification. Instead of trying to guess which one or two companies will explode in value, you can invest in baskets of companies aligned with the themes reshaping the future. So, in 2025, if you're busy working, managing a business, or just living life, you don't have time to track every earnings report or every CEO tweet. Fs do the heavy lifting for you. Sure, buying individual stocks can offer massive upside if you pick the next Tesla or Amazon early, but it's risky. If you're serious about growing your wealth steadily and sleeping well at night, ETFs should form the foundation of your portfolio, with individual stocks as your moonshot bets on the side. Keep it balanced. Growth sectors for the upside. Dividend-paying ETFs for stability and cash flow. 3. Dividend stocks for cash flow. Dividends matter more in 2025 when the market is volatile or moving sideways, and 2025 is shaping up to be exactly that. Cash flow becomes king. Dividend-paying stocks aren't just a way to earn a little extra. They're a powerful engine for compounding wealth. Every quarter, companies send cash straight into your account just for owning a piece of their business. And here's the key: many dividend-paying companies consistently increase their payouts year after year, even through recessions. This means that over time, not only do you get paid, but your income grows without you having to invest more. In 2025, look for companies with a strong track record of increasing dividends, known as dividend aristocrats. These are businesses that have raised their payouts for at least 25 consecutive years. Hinges like Johnson & Johnson, Procter and Gamble, and Coca-Cola aren't flashy, but they're reliable cash machines. You also want to check the dividend payout ratio, basically how much of the company's earnings they're paying out. A sustainable payout ratio, usually under 60%, means they can keep paying you even if times get tough. Reinvesting your dividends automatically through a drip dividend reinvestment plan can supercharge your growth without lifting a finger. By the time most people wake up to the power of dividends, it's already too late. Start now, and your future self will thank you. 4. Real estate and REITs, passive real estate income without landlord headaches. Buying a rental property might sound glamorous, but anyone who's unclogged a tenant's toilet at midnight knows it's not always passive. That's why, in 2025, REITs, real estate investment trusts, are a major opportunity. A REIT is a company that owns income, producing real estate. Think shopping malls, apartment buildings, data centers, hospitals, and pays out at least 90% of its taxable income to shareholders. That means steady dividends for you without any property management nightmares. Some REITs focus on industrial warehouses thanks to the e-commerce boom, others on healthcare facilities and aging population guarantees demand, and others on residential rental housing always needed. REITs like Realty Income or Prologis PLD and American Tower have strong histories of paying reliable income and growing over time. And the beauty is you can invest in REITs through the stock market just like any other stock. No huge down payment needed, no property taxes, no emergency maintenance calls. In a high-rate environment where traditional real estate investing is tougher, REITs give you a way to participate in real estate's long-term growth with much lower friction. 5. Bonds and fixed income, why they matter again in 2025. For years, bonds were the forgotten cousin in investment conversations. When interest rates were near zero, who wanted a bond paying 1%? But in 2025, bonds are making a big comeback. Higher rates mean higher yields and safer, predictable income for people approaching retirement or anyone who just wants more stability in their portfolio. Bonds are once again a smart move. Treasury bonds, municipal bonds, and high-quality corporate bonds can now offer yields north of 4–6%, depending on the term and risk level. Laddering your bond investments, meaning buying bonds that mature at different times, gives you flexibility and reduces interest rate risk. You also want to look at bond ETFs like BND, Vanguard, Total Bond Market, F or short-term treasuries if you prefer something more liquid. Bonds won't make you rich overnight, but they can be the reliable backbone of a balanced investment strategy. Ignoring them in today's climate would be a huge mistake. Blockchain assets, cautious optimism for 2025. Speaking of crypto, 2025 is not 2017 or 2021. The hype cycles have matured, regulatory frameworks are evolving, institutions are getting involved, but volatility is still massive and scams haven't gone anywhere. Bitcoin is increasingly viewed as digital gold, a hedge against inflation and currency devaluation. Ethereum's upgrades make it more scalable and energy efficient. New coins pop up constantly, but only a handful have real staying power. The smartest move: stick to major assets like BTC and ETH if you dabble in crypto. Use reputable platforms. Consider cold storage for anything you plan to hold long-term, and never ever invest money in crypto that you can't afford to lose. Crypto can boost your overall portfolio returns, but it should complement, not replace, more traditional investments like stocks, real estate, and bonds. If you treat crypto like a calculated risk rather than a lottery ticket, it can be a powerful tool. 7. High-yield savings accounts, best places to park emergency cash. It's not exciting, it's not flashy, but having cash set aside in a high-yield savings account is one of the smartest financial moves you can make in 2025. Life happens, cars break down, medical bills pop up, jobs get cut, and if you don't have accessible cash, you're forced into debt at the worst. possible moment. A high-yield savings account gives you a safety net that earns more than a traditional bank account without locking your money away. In 2025, the best online banks and credit unions are offering yields over 4%, and some even close to 5% on savings. That's free money compared to letting your cash sit in an account earning 0.01%. Places like Ally Bank, Marcus by Goldman Sachs, and Capital One consistently rank among the top for high-yield savings. It's crucial to check if the account is FDIC, insured, protected up to $250,000, and has no fees that could eat away at your earnings. Think of your high-yield savings account as your financial bunker, ready for anything, growing quietly while you focus on bigger investment moves. The people who neglect this step always pay for it later. It's not about how much you start with, it's about building the habit of smart allocation and consistent investing. If you have $1,000 to work with, you could divide it into 4 core pillars: $400 into dividend stocks, $300 into REITs, $200 into bonds, and $100 into alternatives like crypto or farmland. With $5,000, you could build an even more diversified. Adding some sector ETFs like technology, healthcare, or clean energy, while still maintaining that emergency fund on the side. The main idea is that every dollar should have a job, whether it's growing aggressively, preserving wealth, or providing cash flow. The biggest mistake beginners make is thinking they need a lot of money to start investing wisely. In reality, the discipline of investing $50 or $100 will builds the exact same muscles you'll need when you're investing $50,000 or $500,000 later. It's not about size, it's about system. Alternative investments, crypto, farmland, private credit, the smart way. In 2025, smart investors know that true diversification goes beyond the usual stocks and bonds. Alternative investments are no longer just for the ultra-wealthy, they're becoming accessible, practical tools for building wealth. No, take farmland. It's quietly emerging as a powerful inflation hedge. People will always need food, and farmland often delivers stable, long-term returns. Thanks to platforms like AcreTrader and Farm Together, you can invest in farmland fractionally, no boots or tractor required. Private credit is also booming. It's essentially lending to businesses outside traditional banks, and in today's higher interest rate environment, it offers attractive returns. You can access this asset class through specialty funds or fintech platforms, giving you exposure to the lending market without being a bank. And then there's crypto. Whether you're a believer or a skeptic, blockchain is here to stay. Bitcoin and Ethereum still dominate, while DeFi continues to evolve. But caution is key. Crypto is highly volatile, treated like hot sauce. A little can spice up your portfolio, but too much can set it on fire. Common mistakes to avoid. While the opportunities are wide open, 2025 will also be filled with traps for the unwary. One major mistake: chasing the hottest investment trend without understanding it. When something is blowing up on social media, whether it's a meme stock, a hyped crypto token, or a brand new AI startup, it's usually too late. By the time you hear about it, early investors are getting out while latecomers are rushing in. Don't be the last one holding the bag. Another mistake: ignoring fees. Small fees, even 1% annually, might seem minor, but they compound over time like termites eating away at your house. Always know what you're paying, especially for mutual funds, financial advisors, or trading platforms. Look for low-cost ETFs, commission-free accounts when possible. Timing the market is another trap. No one, and I mean no one, can consistently predict the perfect moment to buy or sell. Focus on time in the market, not timing the market. The longer your money is invested in solid assets, the better your chances of building real wealth. And lastly, don't neglect diversification. Putting all your money in one stock, one sector, or one asset class is like building a house with only one pillar. It might look fine at first, but one storm and it collapses. Spread your bets smartly, even if you're just starting out small. How to build your personal investment blueprint. The goal isn't just to copy someone else's strategy, it's to build a plan that fits your life. Start by asking 3 questions. 1. What's my time horizon? When do I need this money? 2. What's my risk tolerance? Can I sleep at night if the market drops 20%? 3. What are my financial goals? Buying a house, retiring early, building generational wealth. Based on those answers, you create your blueprint. If you're young and have decades ahead, you can afford to be more aggressive, more stocks, more growth investments. If you're closer to needing the money, you want more stability, bonds, cash, dividend stocks, you should also automate as much as possible. Automatic monthly transfers into your investment accounts remove emotion from the equation. Whether the market is up, down, or sideways, you're consistently buying, consistently growing. And review your plan at least once a year. Life changes, markets change. What worked for you last year might need tweaking today. Your investment blueprint should be a living document, not a set it and forget it file gathering dust. In 2025, the best thing you can do for your future self is take action, even if you start small, even if you feel uncertain, even if it feels slow. The truth is, wealth isn't built in giant leaps. It's built in small, consistent, intentional steps taken every single month. Whether you're starting with $100, $1,000, or $10,000, where you put your money today will determine the life you get to live tomorrow. Imagine yourself 5 years from now, confident, financially secure, options wide open, because you made the decision today to invest smarter. It's not about getting rich overnight. It's about building a life you don't have to escape from. Your future depends on the seeds you plant right now. If you got value from this, make sure to like this video, subscribe to the channel for more no-fluff financial guidance, and comment below, what's one investment move you're making in 2025? Let's inspire and learn from each other. Your journey to wealth starts with one smart step. Make it today.